Welcome, everyone. Let's get started on mastering the backbone of corporate finance, operational efficiency, and internal control frameworks. Today, we transform Treasury from a functional processing hub into a secure, strategic powerhouse. Let's begin by defining operational efficiency and internal controls. In corporate Treasury, processes form the absolute core of the function, while technology acts as the enabler. What do we mean by internal controls? They are the safety mechanisms designed to ensure that procedures are followed in letter and spirit, preventing any financial leakage. Why is this so vital? Because Treasury manages the company's lifeblood. We must mitigate operational risks like manual errors, third-party failures, and fraud. How do we do this? By implementing rigid frameworks that govern every action. In our deep dive, it's crucial to understand that unlike foreign exchange or interest rate risk, operational risk cannot simply be outsourced or hedged away with financial derivatives. You have to accept that people and systems are imperfect, and actively design your daily operations to catch those imperfections before they result in massive financial losses. Take a look at this flowchart on your screen. It illustrates how the Treasury function sits at the top, immediately branching into two equally important pillars: operational efficiency on the left and internal controls on the right. Efficiency flows directly into reduced costs and turnaround times, making the business agile. Meanwhile, internal controls flow into fraud and error prevention, acting as the firm's shield. Notice how both of these outcome nodes converge at the bottom into our ultimate goal: enterprise financial stability. You cannot achieve true stability by only focusing on speed. You must equally prioritize the control mechanisms that protect the firm's assets. Moving on, how do we practically enforce these concepts? We use a specific set of tools. What are they? The arsenal includes the Treasury policy, process maps, standard operating procedures, or process notes, and automated reporting. The basics require us to document everything. Why? Because turnover happens. We need robust process notes so new employees can immediately perform their roles, and so auditors can transparently understand the end-to-end workflow. How do we execute this? Through rigorous process mapping. We map the process by role, clearly demarcating where a human acts versus where a system acts. Taking a deep dive into process mapping, the most critical elements you must identify are the handoff points when a task moves from one person or department to another. Handoffs are the highest risk areas for operational errors. By documenting them meticulously, we can minimize their frequency and tighten our overall control net. This diagram maps out the Treasurer's toolkit for robust operations. From the central control tools node, we branch out to our 5 key elements. Notice the Treasury policy sets the overarching rules. Below that, process maps and process notes define the execution. Look at the dotted lines. Process maps specifically identify handoff points, exposing our vulnerabilities, while process notes standardize the daily workflows. On the bottom branches, systems and technology automate the tasks, and reporting provides the ultimate visibility to management. When these 5 tools operate in harmony, your Treasury becomes a highly efficient, audit-ready machine. Let's explore the golden rule of Treasury design: segregation of duties. What is it? It is the strict division of the Treasury Department into front, middle, and back offices. The basics are simple but absolute. The front office negotiates the deals, the middle office monitors the risk and limits, and the back office handles the actual movement of cash and accounting. Why is this mandatory? Because ensuring that no single individual has end-to-end control over a transaction is your ultimate safeguard against fraud and catastrophic errors. How do we enforce this? Through rigid system permissions. A dealer in the front office must be physically and digitally restricted from accessing the back office settlement screens. In our deep dive, let's focus on the middle office. Borrowed from banking best practices, this team is your control tower. They independently validate pricing, check for limit breaches, and report directly to the CFO, providing an objective audit of the dealer's activities. This organizational chart illustrates the strict segregation of duties. At the top, the Chief Financial Officer oversees all 3 divisions independently. You see the front office, middle office, and back office side by side. The solid lines represent direct, independent reporting hierarchies. Now, pay close attention to the dotted lines, which represent data flow. The front office sends trade data to the back office for settlement, but they cannot settle it themselves. Crucially, the middle office casts a watchful eye over both auditing the front office's limits and reconciling the back office's entries. This triangulated tension is deliberately designed to catch human errors instantly and make internal fraud virtually impossible. Now we must categorize our control mechanisms. What are the two types, preventative and detective controls? Let's cover the basics. Preventative controls are checks that take place in advance. Their job is to stop a policy breach, an error, or a fraud attempt before the transaction is ever executed. On the other hand, detective controls are designed to highlight problems that have already occurred. How do these work in daily operations? Imagine a business unit requests a massive foreign exchange trade. A preventative control evaluates that request against corporate policy and stops it if it exceeds the limit. Conversely, when you download your bank statement every morning and reconcile it against yesterday's expected cash flows, you are performing a detective control. If funds are missing, the event has already happened, but you have detected it swiftly. For our deep dive, remember that world-class treasuries mandate both. Preventative controls act as your locked doors, while detective controls act as your security cameras, ensuring nothing slipped through. Let's trace the life cycle of a transaction through our control gates. On the left, a deal request is submitted. It immediately hits the diamond, the preventative control. If it fails policy, it takes the top path and is outright rejected. If it passes, we execute the trade and settle the funds. But the process isn't over. Post-settlement, we hit the second diamond, the detective control. During morning reconciliation, if there is a mismatch between the bank statement and our ledger, it flags an investigation. If it matches, the item is officially reconciled. This ensures security at both the initiation and conclusion of every cash movement. To truly secure operations, we must utilize technological integration and automation. What does this entail? We must aggressively transition away from manual spreadsheets and adopt integrated treasury management systems, or TMS. Why is this urgent? Survey data reveals that over 70% of treasuries still depend on highly vulnerable, disparate spreadsheets. This creates unacceptable operational risk and latency. How do we fix it? By connecting our TMS directly to our ERP and banking partners via APIs, achieving straight-through processing, where data flows without human touch. Let's look at a technical deep dive with our sample code concept. When you configure your TMS, you use JSON payloads for role-based access control. For example, assigning user dealer 01 the permission to execute FX with a limit of 5 million. By hard-coding this configuration, the software physically prevents the dealer from accessing settlement screens. You are literally turning your written segregation of duties policy into an unbreakable digital wall. This sequence diagram walks us through an automated, straight-through processing workflow. First, the corporate ERP pushes approved payables data to the Treasury system. Second, the TMS automatically performs a preventative limit and roll check. Third, having passed the check, the TMS fires an API payment instruction directly to the global bank. Zero manual data entry is involved. Fourth, at the end of the day, the bank sends the electronic statement back to the TMS. Finally, the TMS executes auto-reconciliation, acting as our automated detective control. It is fast, efficient, and highly secure. Operational efficiency must go hand in hand with information security and compliance management. What are we doing here? We are protecting highly sensitive financial data and ensuring we meet all regulatory mandates. The basics require implementing ironclad IT security protocols, particularly when you use cloud-based SaaS solutions or outsource back-office treasury functions. Why? Because a data breach or compliance failure can result in devastating financial losses and severe reputational damage. How do leading firms manage this? They use automated compliance management systems, or CMS, which provide the CFO with a real-time dashboard of compliance metrics, transforming an administrative headache into a streamlined process. For a deep dive, let's look at a case study from NASA regarding IT security in outsourcing. When NASA outsourced a major project, they realized security protocols weren't adequately contracted. They had to renegotiate to classify data properly, such as sensitive but unclassified, and train the vendor. The lesson for Treasury: your data security standards must be legally bound into your vendor and banking contracts from day one. Let's trace how data flows into a secure compliance framework. At the top, raw Treasury data enters the data classification diamond. If it's public, it gets standard encryption. But if it's sensitive financial data, it routes to high encryption and multi-factor authentication. This strict standard is then legally embedded into the vendor SLA contract. Finally, Adherence to these security protocols and regulatory requirements feeds into an automated CMS dashboard, providing the CFO with real-time visibility and confidence that the firm is fully compliant. Let's examine a real-world, highly critical use case known as the insider fraud. Imagine a centralized treasury that managed escrow accounts for unredeemed dividends. The problem: the employee in charge of these accounts, let's call him M, realized that these specific accounts were excluded from the daily detective reconciliation process. Seeing the loophole, M executed a series of forged funds transfers over 15 months, siphoning off more than $400,000 in small, undetectable increments. The bank called to verify a transaction once, but because M was the designated account contact, he simply authorized his own fraud. This is a catastrophic control failure. The preventative controls were bypassed by forgery, and the detective controls simply didn't exist for those accounts. The fraud was only discovered when a suspicious colleague blew the whistle after noticing M's lavish lifestyle. The takeaway: never leave any account out of your automated reconciliation process, and strictly enforce segregation of duties so the person initiating the transfer is never the one reconciling the bank statement. This sequence diagram illustrates the anatomy of an internal fraud. First, employee M sends a forged wire instruction to the bank. Second, the bank spots an anomaly and calls to verify, but because M is the sole contact, we see a massive control gap. Third, M fraudulently authorizes the transfer. Fourth, the funds are released. Fifth, the bank sends the daily statement to the firm's detective control system. But look at the critical note at the bottom: the reconciliation system was programmed to ignore the dividend accounts. The fraud goes completely undetected. A chilling reminder that a control system is only as strong as its weakest link. As we look toward the 2030 vision, Treasury operations are undergoing a massive shift. We are moving from batch-processed, end-of-day reconciliations to continuous, real-time control analytics. The future relies heavily on integrating artificial intelligence for payment anomaly detection. Why? Because as the velocity of global cash increases, manual mid-office controls are simply too slow. Industry leaders are now targeting greater than 90% automation for all back-office activities. How will this work? Machine learning algorithms will ingest years of historical vendor data. If a payment suddenly deviates from a known pattern, say, a different banking country or abnormal amount, the AI instantly flags it, preventing fraud before the cash leaves the building. To prepare, you must embed these continuous controls and upskill your teams on digital risk management. I invite all learners to like, subscribe, and visit quicktechie.com for premium certification prep. At quicktechie.com, you'll gain access to extensive Q&A banks, full ebooks, audiobooks, full-length training, and interview guides to secure your future in finance. Thank you for watching. Our final diagram projects the evolution of Treasury controls. We start on the left, moving from traditional controls via AI integration into real-time anomaly detection. Concurrently, we transition manual processes via massive automation into continuous control analytics. Both of these modernized pathways converge into the central node, the 2030 Strategic Control Tower. This is the ultimate future state of the Treasury function, outputting unparalleled enterprise agility and security. Thank you for joining me on this journey to operational excellence.